Let's talk about the real basic essence of stock trading. What's really going on here? And at the base level, you have folks that are investing in stocks, and some folks want to buy stocks or buy more of a particular stock of a company, and other people want to sell that stock of a company. And when they reach an agreement on a price, I will buy it for this price, you will sell it for that same price, then we have a trade, right? I'm buying and you're selling, and now we've reached an agreement on price. In effect, we have a contract to sell. Don't really think of it as contracts, but it's really what's happening is we have an agreement. And I buy, you sell, or vice versa. And that's what's underlying what is happening is on the stock exchanges, we have thousands and thousands, tens of thousands of traders who are buying and selling all throughout the trading day. Now, when this occurs, something that's really underlying this is supply and demand. If you've had economics courses, you're familiar with supply and demand, certainly the supply and demand curve. But basically, when there are more buyers than sellers for a particular stock, that tends to drive the price up. The price of the stock will go up. And when there's more sellers than buyers, then the price will go down for that stock. And thus, when we reach the middle point, that's when there's an agreement on the price and we actually have a trade. But when there's, let's say, more buyers for something, maybe there's some great earnings news, or there's something, a pharmaceutical company had a great new blockbuster drug, and now people want to, are in a frenzy and want to buy that stock. Well, now the price goes up because sellers can get more for their price, is basically what's going on here because there's such high demand. Let's use an example here. If you think back to the early days of COVID, and we had the COVID lockdowns. Remember those dark days when people couldn't go to restaurants, people couldn't go anywhere, and everybody was locked down. And what happened with certain stocks in the stock market there was really a good example of supply and demand. People looked at a company like, let's say, Zoom with video conferencing, and they're like, well, everybody's locked down, companies have to work remotely, virtual offices. What's the company that really caters to that market? Well, of course, Zoom would be one of those companies, and Zoom stock zoomed right up in that period because of the change in the landscape due to COVID, right? So people are like, oh, well, I really want to buy Zoom. The Zoom price is going to go up, and then that drives the price up. And thus, if you wanted to buy Zoom, you were paying more of a premium price. On the other hand, due to COVID lockdowns, what was being really locked down, of course, was cruise lines or cruise ships. NCLH is Norwegian Cruise Line Holdings, or Norwegian Cruise Line. So if you're familiar with them, they're a big cruise line company. And before COVID happened, they were very successful. All the cruise lines were really near some peak numbers. They were doing great. And then, of course, when COVID happens, they all got shut down. They couldn't even sail because of the COVID lockdowns. Later, that started to open up. But in the early days, you couldn't go on a cruise. So what happens to the stock price? The price goes down. The cruise lines don't have really any earnings. They're just trying to stay afloat. If you get that kind of dark joke, they're just trying to stay afloat. So those are things that can happen in the external environment that can cause things to either rise in price or fall in price, in addition to whatever the company strategy is doing or how well they're doing, like with their earnings or their different ratios or what their stock chart might say. In the end, all that's kind of going on behind the scenes, the essence is we have buyers and sellers. And people buy and sell based on their outlook on the company. I mean, the last big thought to take from this is that when you have a buyer and a seller, that means somebody thinks the stock's going to go up and somebody thinks the exact opposite, that the stock is going to go down in price. And thus, we have the trade. But understand that no matter how enthusiastic you might be in a stock, there's another person on the other side thinking, maybe not so much. And that is the essence of stock trading. So I put together a real handy kind of chart or whatever, and we're going to fill in this chart with some example companies. But let's start by understanding how stocks are organized using this chart. So first off, on the left-hand side, you have market cap, right? So this is looking at the size of companies. And then on the top, you're going to have these styles: growth, income, or dividend stocks, and a blend, right? So you have market cap and style. All right, so let's first start off and try to define this a little bit and exactly what do we mean by these kind of two ways of organizing stocks, a little more detail. So if we look at market cap, basically market cap is just a simple way to identify the size of a company. Is it a big company? Is it a small company? Or is it maybe in the middle? And really, it's just they use a simple formula, really. It looks at the number of shares of stock on the stock market. We can buy 1, 2, 50 shares, how many shares of a stock you want to buy, or units of stock you want to buy. And it looks at the total number of shares on the entire stock market for a company. So it could be millions of shares that are out there for the total stock market. And then it's multiplied by its current stock price per share. So, how much is it selling per share? So for example, if company A has 1 million shares that are available to people to buy and sell and trade, and right now it's selling for $55 per share, then the company would have a market cap of 55 million, and which would put it in the small cap category. If we were to look back at our chart, it would put us in the small cap category. So it's simple. That's a simple way of comparing size of companies between each other based on the number of shares and their current price per share. And so you can see here, pulling from that chart, we have mega caps, which are these really large, $200 billion or larger in market cap. Large would be 10 to 200 billion. Mid caps would be 2 billion to 10 billion. And then we were saying initially on the chart, to keep the chart simple, we're saying 2 billion and less was small cap. And that's usually how it's expressed. But sometimes folks will express it, especially some mutual funds and all that, might have things like micro cap or nano cap. So if you see that, they're just breaking that small cap down further. Micro would be 50 to 300 million, and nano would be less than 50 million. So if it breaks it down even further on the bottom end, that's how it would basically do that. So if you looked at our company A from the example with a market cap of 55 million, where would it fit? Well, it seems pretty simple, right? It's right there in the micro cap 50 to 300 million. So that's how they'd be organized as far as the size of the company. Now, when we talk about the top part of the chart or the style part of the chart, that gets really into the idea or the concept of how do you make money in the stock market? We know we can make money in the stock market, but how do you do it? How does it actually work? And there's really two ways you make money in the stock market. One is price appreciation. Basically, that's that whole concept of buying low and selling high, right? If I bought my stock at 50 and now I sell it at 100, well, I doubled my money, right? I bought it at 50, I sold it at 100. That difference between the two is my profit. Between the 50 and 100 is profit, which in this case would be 50. But if I bought it at 50 and sold it at 75, then I made $25 in profit. By the same token, if I bought it at 50 and sold it for 40 because I just had to get out of it, it just wasn't working out, I would have lost money. You lose some of the time too. So I would have lost $10. But basically one of the primary ways of the two ways you make money in the stock market is price appreciation. Buy low, sell high. The other way is dividends. And dividends are basically, just by holding the stock through a period of time, typically every 3 months, dividends are paid out. I get paid money. Like, that's great, right? I mean, it really is. It's a great way to, not only have your price go up in your stock, but along the way, if you're holding, especially for long periods of time, you get paid that regular amounts of money. And we'll show you, how to interpret that and how to look at that, how much you're getting paid and how to evaluate that. That's in day 3 again. So where we'll talk about how to compare stocks and which ones in terms of dividends are either not paying a dividend or how much they pay you. So you can kind of evaluate that. That's in the evaluation phase in day 3. Right now, the thing to know is that some stocks pay you dividends. And so every 3 months I get paid money. And that's just like cash, really. I mean, get kind of a check. I can use that money to, buy things, or I could reinvest it too and just be set up to be automatically reinvested so I keep buying more stock. So there's different things you can do with your dividends. But the key takeaway is you get paid money. And then you have a blend. Sometimes they're called core, but they're called a blend, where you have basically a little bit of both. They're both price appreciation and their dividend, and it's kind of in between. So we break that down a little further. All companies want price appreciation, right? Nobody wants the stock price to go down, but some really focus on that more than others. And that's where you might hear the term like growth stocks. Growth stocks want to give you even more price appreciation and faster, right? You see that a lot with a lot of new companies or technology companies, where they might not pay a dividend at all. In fact, typically they don't pay a dividend at all, but they want to grow that price faster, and they keep reinvesting in the company. Instead of paying out money to shareholders, you and me, they reinvest in the company to grow that price even faster. So Amazon, instead of, let's say, giving us money in terms of a dividend, they'll say, well, we won't give you money, but we'll grow that price even faster than other companies because we're keep reinvesting, building more distribution centers, expand Amazon Prime, really grow Amazon Web Services or AWS. There's lots of different things they do besides their e-commerce. So all companies want that, and some just focused on that, meaning they don't pay a dividend. Now, some companies, like they're not growing as fast, and they can't grow their price as fast, so they want to reward you with a check, basically every quarter. That's the dividend. That's the money of the income they're going to pay you. You see a lot of that with utility companies, for example, where they're wanting to. You can't really grow utility companies. I mean, sure, they can expand maybe into sustainable energy. Energy might be good. They can raise their prices maybe a little bit, but it's very government regulated. So instead of being a fast grower like a technology company or a biotech company, they're going to say, okay, well, our stock price won't go up as much, but we'll pay you income and we'll pay you a dividend. Real mature companies, that don't have as big a growth prospects now, would do that. Like think of like Coca-Cola. They're always raising their stock prices. The idea want their stock price to go. They're expanding in other markets and things, but they already have a really large market share. They're not they're not the next Amazon. They are Coke. So they pay a dividend. And then you have companies that are a blend, right? They might pay you a smaller dividend, but they want and they want faster price appreciation. They're kind of in the middle, right? So they're not like a real growth stock company that is all about let's raise that price and by being successful. And they're not a dividend company. It's like, yeah, we're real solid. We're rock solid. We make money. We're going to pay it out to you in income. They're kind of in between those two. Okay, so if we go back to our handy dandy chart, we can see that we can organize stocks by how big they are, the market cap, and the style, right? Growth or income or dividend, income dividend used interchangeably, or if it's in that in-between spot, right? In between growth and income, they're kind of like a blend, for example. And each one of these squares can be filled with different stocks. So you could have large cap stocks that are also growth stocks. You could have small cap stocks that are blends. You could have mid cap stocks that are income, so you can find stocks in every category. Okay, let's take a moment here and let's look at some companies that fit in each of these slots to give you a little feel here. So if we start at the top of the mega cap, this might be some companies you recognize because they're big brand name companies. So for example, if you think of like growth stocks that are really big companies, well, we were talking about Amazon, right? Real dominant company, and they're a growth company, right? They're still growing. They've got a lot of room to keep growing. So they're more focused on that price appreciation, don't pay a dividend, and so they're a big mega cap growth company. A big company, mega cap company that does pay a dividend, they're still growing, of course, but because everybody wants price appreciation, at least some, but they really pay a nice dividend, have for, I think, over 80 years. So they're real consistent. That's Johnson & Johnson. You probably know them for making like COVID vaccines, but they do a lot of other pharmaceuticals. They make a lot of other things like Band-Aids or adhesive bandages. They do a lot of different products that they do. So Johnson & Johnson would be more of a dividend type stock. And then a blend company would be kind of a little bit of both. And this is where sometimes people get arguments like Apple and Microsoft. Are they growth companies? Well, of course they're growth companies, but they're also pay a little dividend too. If they pay no dividend, then they would be really a true growth company, but they are growing and they're growing well and they're growing fast, but they also pay a small little dividend too. So they kind of fit in that little bit of a blend category. Though a lot of people want to argue that, no, we're technology, we're not a blend, so, but really if they're paying a little dividend, they're probably going to be more considered a blend. If we look at large companies, these are smaller than the mega caps. Growth company, example, would be like Airbnb, right? So they're still growing, don't pay a dividend, they're growing. We'd looked at General Mills in day one, they're a large cap and they pay a dividend, pay a nice dividend actually. And so we'll learn about that in day 3 coming up. And then a blend that's kind of between where they're really trying to grow and want to expand their banking services, but they still pay a dividend, might be something like Citigroup or, formerly known as Citibank. So Citigroup. And we start going to mid-cap companies that are a little bit smaller. You might recognize some of them, some you might not. ADT, growth company, security. They do security devices. They're still growing, trying to get more people to buy like home alarm systems and security. Harley Davidson, which is an income-producing stock. You know them for their motorcycles, and they pay out a nice dividend. And then a blend in between the two, again, a little bit of a technology company would be Juniper Networks, for example, where it's a growth company, but tech company, but also pays out a dividend too. And then if you look at small cap, under 2 billion, and, Neximmune, these might be some companies you may not be as familiar with because they're smaller. Neximmune, high growth company. They're a biotech company looking at things like how to cure cancer and developing, vaccines. Certainly a high growth area, right? In both those areas. I mean, if you get by a Neximmune and they really help with cancer treatments or even cure cancer, my gosh, their stock price will go way up, right? So, but right now they're small cap, right? There are a number of shares out there times their stock price puts in that 2 billion or less range. Income producing company, small company, is ACCO Brands. May not have heard of them, but they do like office supplies. So a lot of paper clips. So the world needs paper clips. And so there's steady income coming into the company, steady earnings typically with them because everybody's going to need a paper clip or a stapler or file folder. And so ACCO Brands sells those products and they pass along a nice dividend to people. And then a blend in between where it still want to grow, but they're paying out a little bit of a dividend is Del Taco, which is a restaurant chain. And you can imagine what they sell. They sell tacos, amongst other Mexican and Tex-Mex type food. So you can see how companies can fall in these different styles and sizes. And they can move between them too. If Neximmune all of a sudden really takes off and their share price goes up, they might move up into that mid cap, maybe later to large cap and mega cap. All companies, typically will start in like a smaller cap type range, as they're growing their company, like maybe a Neximmune might do, or maybe Del Taco and ACCO Brands. I'm not sure how much bigger they'll get, but we have hope for tacos, so Del Taco might get bigger. So either way, when you're investing, you can start thinking about diversification, right? So not only is it like, well, I want to have stocks, I want to have bonds, and I want to have cash, but within the types of things you might buy, like in your stock investments, you can kind of mix in amongst this chart. So you're not, let's say, all my money is in large cap or mega cap growth. Maybe I want to have some in a small cap blend or a mid cap income stock. So that's another way that you can use this and evaluate stocks. One quick note too, you might have heard the term value stocks, right? Or value investing. I have a whole course on value investing. So value investing or value stocks are basically stocks that have fallen on hard times, but they may be a buying opportunity now. So, and they can fall in any cap or style box, right? You can have mega caps that are struggling and so their prices are low, their stock price is low, but they're still consider a growth mega cap or a mid cap blend or whatever it is. It's really looking at stocks where their prices have gone down, and because their price has gone down, they might still be a good company underneath and ready for a turnaround and might be a buying opportunity. So that's value stock. So different than like growth and income and blend. Of course, we are dealing with the financial industry, right? So they try to confuse stuff. They really do. I wish they wouldn't, but they do. So many times, especially mutual funds do this, is where they'll use the term value stocks as the same as income and dividend stocks, that's interchangeable. So you might look at a mutual fund that says, we're a large cap value mutual fund. So if you buy us, you're going to get large cap value stocks. But they're not really value stocks as far as stocks that have been beaten down and might be a good value or a bargain. They're basically income and dividend stocks. And you can tell if you see something like that because you'll look at, let's say, a mutual fund at their holdings, and they're like, oh yes, we're looking at value stocks. And then they have things like Apple and Microsoft and Johnson & Johnson, these great companies that are not on hard times, that are not value stocks at all as far as beaten down in price. These are good regular income dividend payers with some potential growth. So there are mutual funds that focus on actual beaten down value stocks. You just have to look closely at it. So if you see somebody saying, oh, that's a value stock versus a growth stock, they're really probably more talking about dividend or income versus you're talking to somebody who really is, talking about stocks that are on sale or really beaten down, then they might be more talking about a value stock. All right, so a little confusion there. The industry does, just something to be aware of. But really what you're looking at is growth and income, and then a blend might be the way to look at it. This is great, Steve, but how do I find stocks that, fit in that category? How do I actually find them? Well, one thing is when you're looking at your stock quote, a really easy way is, does it pay a dividend or not? Yes or no, right? If it pays a dividend, then it's an income stock. If it doesn't pay a dividend, you can count it as a non-dividend paying stock or a growth stock. So growth stock, no dividend, income stock or dividend stock pays a dividend. Now we do have some that are a mix of the two, right? Like we talked about Apple and Microsoft. So you have to kind of take that in consideration as well. But the simple way is just look at that dividend part. If you want a little bit more, more exacting way is to find lists where they list like, dividend stocks and and blend stocks and growth stocks. And you can find them, just search the internet. I'm going to show you one here real quick that's kind of nice, which is from Morningstar, which is a service. They have a lot of free stuff and they have a lot of pay stuff too, but a lot of their free stuff's good. So I'm going to show you a free way to kind of look at some lists of these different stocks. And their site's a little weird where I'm going to jump right to the large cap growth stocks. That's where the link is, but I'm going to show you where to find all the different variations of stocks here coming up here. So let's take a look at these lists here from Morningstar to help you find, the stock in the category that interests you. Okay, I'm over here at Morningstar.com / large cap growth stocks. They don't have a direct link to this stuff, so this link will get you there, and then I'll show you how to find small cap and mid cap and the various other styles. So if we go here, you can see that they have a nice thing about large cap growth stocks. Tells you, kind of what they are. They're growing, projected to grow faster than the other large cap stocks, so they stick them in that category. And if you scroll down, you'll just see a whole big long list of different stocks, a little bit of information, and you can click through if you want more information. So a lot of these you might recognize, like Adobe, Berkshire Hathaway, Chipotle, all sorts of different places that you might recognize for our large growth stocks that they have there. There was Moderna, Monster Beverage, NVIDIA, so a lot of different ones, right? So Zoom's probably, yep, there's Zoom at the end. So this would be large cap growth stocks, and where you can find more different stocks by classification. They have, these things are premium things where you have to pay for, but this is all free up on top there. And then down here where it says all stocks by classification, you can look under that stock style and you'll see large cap growth, which is what we're looking at. Here's an instance where they're using large cap value to mean dividends or income producers. So this is actually dividend income and not necessarily undervalued companies. And then core would be like your blends. So that's the in-between guys. And then they have the same thing for mid cap and the same thing for small cap. If we were to go into like large cap value, you'd start seeing, it would pull that up in a moment. There we go. And it says your stocks that are less expensive are growing more slowly than other large cap stocks. And they're slow growers, and they're probably going to have high dividend yields. It means they're going to actually pay a dividend. So you got like AbbVie, Aflac, AT&T, Boeing, so big dividend type payers are up here in that category. And like Xcel Energy, which is a utility company, those types of things would be in there. So there you go, large, mid, small, value would be income, blend, and growth. The other nice thing they do is they also have it broken down by sector, right? So you can see all these different types of sectors. And if you're interested in, let's say, technology, you just click on it. Now, unfortunately, they don't break it down by large, mid, and small cap when you go into a sector, but you can at least get a big long list of all these different companies in the technology sector. Some you might recognize, some you might not, right? So as we go through it. And basically you have, at the bottom, you have pages and pages of the stuff because it's everything in that sector. Same thing with world regions. So you can go into a particular region and see information that you might want to see in all these different types of regions. And then if you find something, you can click on it and learn more about it. Or you can use Yahoo Finance or whatever. Here's Apple, for example. But let's say we're going to look at AppLife Digital Solutions, right? So we say, well, what's AppLife? And then it would give you a little bit of information, kind of that same kind of stock quote stuff we were just learning about. And give you a little profile about them. It uses digital to create apps and websites. Okay, well, that makes sense. Probably a lot of you know them. I don't know them as well. So, okay, so there you go. So there's a software application technology company. So basically get here, you can go Morningstar / technology stocks, or do like I did where I went right through to the large cap growth. That's the link that I was kind of showing you there. Different ways you can kind of get there. There's no other really good way to do it. So with that, that's another way that you can look up stocks through Morningstar, and there are other similar services out there, but this one seemed pretty nice. Let's talk about mutual funds and exchange-traded funds. They have a lot of similarities, but they have some key differences. In particular, if you want to be a more active trader, one of these two is definitely one that you want to really focus in and key in on if you're an active trader, and you'll see that as we go through this lesson. So first, let's talk about what are the similarities between a mutual fund and an ETF, or exchange-traded fund. So basically what they both are is they're a basket of securities. You're buying a whole bunch of something, a stock, let's say for stocks, for example, and that provides you some instant diversification because you're not buying one stock, you're buying one mutual fund or exchange traded fund, and in that it holds a whole bunch of different types of stocks. So for example, a famous one is the S&P 500. So that holds the 500 largest United States stocks, right? So right there, I'm getting 500 stocks just by buying one mutual fund or exchange trade fund. And you can get an S&P 500 in both a mutual fund and an exchange trade fund type of style. Another one would be like the Nifty 50, which is the 50 largest India-based stocks based on market cap. So, but you can also get more specialized. Like let's say you want to invest in a basket of stocks that are focused on EVs or electric vehicles. You can do that. And that way I don't have to try to buy 10 or 15 different electric vehicle companies or related companies. I can just buy the mutual fund or exchange traded fund and get some diversification. And they go beyond just stocks too. They could be, bonds or other types of securities out there, gold, whatever it might be. You can find a mutual fund and exchange traded fund for basically anything. So the other difference is how actively they're traded within their basket of holdings. Mutual funds and exchange trade funds, they all have fund managers. You have somebody who's in charge of the investments in that fund, and they usually have a team of people that work with them to help pick the different investments. And it also depends on how active a fund manager they are, or if it's more of a passive or index fund. So let's start with a passive or index fund. So when we're talking about that, Nifty 50, the 50 largest Indian stocks, there's no active management of that. You just have to buy the 50 largest Indian stocks or the S&P 500, or the 500 largest U.S. stocks, and that's all you do. So it's a very passive index fund. And the advantages of index funds is they have they're much low cost versus, let's say, an active type of fund. An active fund is where the fund manager is actively picking stocks, buying and selling constantly, to have the right mix of stocks. So maybe that electric vehicle fund, as an example, you might have somebody who's actively managing the fund and saying, okay, I want to put more weight, put more investment on Tesla and less so on NIO or some other related type of electric vehicle company, as an example. So how active the fund manager is can make a difference between these different funds. ETFs or exchange trade funds tend to be more passive or index funds, but they don't have to be exclusively, but you'll see that much, much more often with an ETF that they're index funds. Many people say that index funds, by the way, because they can be low cost, you don't have to pay that fund manager and a bigger team to really be actively researching and finding stocks, can be a better way to go because it's lower cost and it's hitting more of the average of the market without trying to beat the market, so to speak. But they both have their place. So you have active or passive funds. So in addition to similarities, mutual funds and exchange trade funds, they have costs associated with them. It's not a free lunch or whatever. So there is some cost related to the people who manage that fund. Active mutual funds are going to be higher cost than index mutual funds or exchange traded funds. So right now they're both the same. We're still with our similarities. They'll both have what's called, the main thing you'll want to look at when evaluating a fund is an expense ratio. And that's the annual percentage to hold the fund. So if I'm going to buy that fund, I'm going to pay an annual percentage, to hold that fund. If I sell out before, I'll pay a portion. If I sell it halfway through the year, because I can buy and sell at any time, then I'll pay that a smaller percentage of that. But basically, when you look at expense ratio, it'll say that that's the annual percentage to hold the fund. And you really want to look for something under 1% as far as that expense ratio. Some are 2 or 3%, but there's so many different mutual funds and ETFs out there. You can find a lot of great funds that are going to cost you less than 1%. In fact, there's a lot of great funds that are out there you're going to find for less than 0.25% or less, or even almost to zero, or even at zero. I mean, this is a new thing in the market, so be watching for these ultra low cost expense ratio funds. Because understand that eats away on your return or how much you'll eventually make, because each year you're going to have a little bit of money go out for that expense ratio. But then again, you're getting that instant diversification. One thing you might see out there was what's called a load fee or a sales charge. They mean the same thing. Again, this is mostly with mutual funds, though. I don't know if you'll see it much, if at all, with ETFs, but mutual funds, you definitely can see them. And these are rare. They're getting rarer now because there's so many good funds that are no load, where you don't pay a load fee or a sales charge. This fee or charge is an addition on top of your expense ratio. But there are some mutual funds that you still do. And basically, it's a fee that you pay initially that's the extra fee for the privilege, and it is a privilege, to buy that particular fund. Not only are we going to charge you annually with an expense ratio, but just to buy in, we're going to charge you a fee up top. That's the most common, which is what's called a front-end load. And usually it's around 1 to 3%. So when you buy a mutual fund and it has a front-end load, it'll tell you how much it is, but you might pay 1 to 3% of whatever you invest right off the top. And so if I invest, $10,000, I would be paying, 1% of that, or $100 US, just to buy the fund. I'm not getting anything from it. It's just to buy the fund. So that's a front-end load. You also can have what are called back-end loads, where when I sell the fund, I get charged too. Some might have only front-end loads, some might have only a back-end load, and some have both. The key thing is, you don't have to buy these types of funds. There's so many good mutual funds and exchange traded funds that have no loads at all. So I would highly, highly recommend not buying a fund that has a load fee or a sales charge. Buy no load mutual funds and exchange traded funds. There's many of them out there, thousands of out there, maybe tens of thousands. So, but just understand that if you see something that says load fee or sales charge, that's what it is. If we look at an example here from this Global Technology Fund from Putnam, you can see this is when you go on a website for like a mutual fund company or whatever, they'll give you disclosures as far as what are the expenses there, right? There's usually what's called a fact sheet that tells you about the fund, its performance, and its expenses, and you can get this information from there. And so if we look at the expenses here on this particular Putnam fund, they have an expense ratio of 1.10%, right? So it's 1.1% you're going to pay annually for this fund. So like I said, you can find some under 1%, some even less, but if you want a fund that really is focused on technology and you like this Putnam one, you can buy it. You'll pay your annual expense ratio 1.1%. The other thing that they're doing too is they have a sales charge that's the same as a load, and they break it out by how much you're investing in the fund itself. So if you, let's say, have from 0 to $49,999, let's call it $50,000 US. If you invest in the fund, you're going to pay up front, right off the top, just coming right out of your investment, 5.75%. That's really high. It's really high. All right. Now, if you pay more, if you say, well, I'll give you 270,000. Well, you can see you can go up to 2.50% or get it down. And you can see the different, amounts there. So, but if you want to turn this into a no-load fund, hey, you only need $1 million US, and you can, pay zero. Otherwise, if you're only investing $500,000, you're still going to get charged a 2% sales charge. So now here's the deal: there are a million, well, not a million, but there are hundreds, thousands of funds that you can get with that focuses on technology and global technology that doesn't charge this type of fee. You'd have to look at their performance, how much you believe in this active fund manager in this particular thing, but those are pretty hefty fees. But that's kind of what it would look like. So let's talk about some differences here real quick. One, and this is really a real important part now for if you want to be actively trading stocks, because you can actively trade exchange traded funds, less so with mutual funds. And here's how it works. So mutual funds, as far as how they're traded, is they're traded once per day, right? So throughout the day, you can buy from the mutual fund company right directly from like Putnam there we were talking about, or Vanguard, or Fidelity, or Schwab, or any of these big mutual fund companies, or even small ones. And if you buy a mutual fund, it basically, the price trues up at one time at the end of the day, and then you get it at that price, and then you hold it. And when you sell it, you'll wait for the end of the day, let's say weeks from now, years from now, and that'll be the price. One time per day. So you can't actively really buy and sell it throughout the day. If you're a day trader, for example, you can't day trade mutual funds because it's only one time per day. You can't go in and out of them. Now, with an ETF or exchange traded fund, that's where that name comes in. They're traded on a stock exchange. They basically trade just like individual stocks. So if I want to buy a stock and then sell it 10 minutes later, I could do that. If I wanted to buy an exchange traded fund and then sell it 10 minutes later, I can do that. You can day trade them. You can trade them as much as you want. They're very liquid, means they're easy to buy and sell throughout the day. So you don't have to wait to the end of the day. So if you're looking to be more of a where you're focusing on actively trading, that's where ETFs really shine. They shine with low costs, particularly if they're an index fund, and they shine as far as something that's being able to trade in and out of the day. So if you're a scalper or a day trader or somebody who might want to trade more frequently or don't want something that might plummet in a day because the whole, let's say, electronic vehicle industry went down in a day and your mutual fund went down, you want to be able to sell it in the day, not waiting to the end of the day, then an ETF may be for you because that is a big difference. The other thing is minimum purchase. Mutual funds, you're buying from the fund company, they can set their minimum purchases and say, you can't buy this fund unless you come up with a certain dollar amount, or rupee, or a pound, or euro, whatever your currency is. So like that Vanguard S&P 500 mutual fund, this is the mutual fund part of Vanguard, it's the S&P 500 largest stocks. The minimum investment is $3,000, right? So you need to come up with $3,000 just to buy, one share of that fund. Now they have an exchange traded version of that fund, the Vanguard S&P 500 ETF, and you can see how their ticker is different, VOO versus VFIAX. That's how they separate them. And so you can buy an exchange traded fund that tracks the exact same S&P 500 largest stocks, exactly the same, and you can find this with pretty much anything. So to buy one share, you're buying it on a stock exchange, you're buying it through your stockbroker, and you pay whatever it's selling for. It might be selling for $20, or $400 or $30. You don't have to come up with that minimum $3,000. You could buy one share or two share, whatever you wanted to do. So again, gives you more flexibility with the exchange traded fund. So in summary, basically, if you're an active trader, you don't want minimums, you want to be able to trade it, maybe you want to day trade something, then ETFs are for you. Then you really want to focus on ETFs. If you're more of a buy and hold investor or might buy a mutual fund and hold it for a long period of time, particularly look at those expense ratios too, if you're going to hold something for a long period of time, then you could buy mutual funds or ETFs. You could buy either one. And this is why ETFs are really growing in popularity. Low cost in many cases, and that flexibility, and you don't have these minimums. So there are mutual funds out there. People own mutual funds. There's nothing wrong with mutual funds. But ETFs kind of came out of the mutual fund industry as far as another alternative where people could buy and sell on exchanges. So either way, no matter where you're at in that trading spectrum, ETFs will work and work very well.